What's up, everybody? Joe Brown here. This is Heresy Financial, and today we are answering the question of what is the impact on prices from derivatives. Derivatives are blamed for price manipulation, price suppression on things, especially like silver, and increasingly so things like Bitcoin through the relatively new Bitcoin futures. And so today we are going to talk about the impact that derivatives have on prices and whether or not they automatically or inherently mean that there is some sort of price manipulation or suppression going on through the use of derivatives. Ready? Let's dive in. All right, so we have to go through a little bit of a progression here in order to understand what impact derivatives are having. The first thing we need to understand very clearly is pricing, how prices are arrived at in markets, in public markets. And so basically what's going on here is you have an auction taking place. Let's use the example of Apple stock. You've got one person over here that says, I would like to buy a share of Apple stock for $1. That'd be great, right? You've got another person over here that says, I would like to sell a share of Apple stock at $1,000. So that's the extreme, right? Let's say $1 is where somebody wants to buy it at the lowest. $1,000 is where somebody wants to sell it at the highest. Now you've got a third person who comes in because those two people, they're not meeting in the middle. This guy says 1, this guy says 1,000. You've got a third person enter. And let's say they want to also buy, but they're saying, hey, you know what? I'm not going to sit around and wait to see if somebody wants to sell it to me at $1. So I'm going to come up. I'm going to say I'll buy at $100. You've got another person comes in who's a seller and says, hey, I'm not going to wait around for somebody to buy it for me all the way up at 1,000. So I'll come in at $500. Now the spread is tightened. The spread used to be almost $1,000 from 1 to 1,000. Now the spread is 100 to 500. You keep on having new people enter the market who want to either buy or sell until a trade happens, a match happens. You have a buyer meet a seller at the middle and a transaction actually takes place. Right now, those transactions are taking place at around $180. You've got a lot of buyers who have bids out and they're trying to buy at a bunch of different prices, and $180 is right about the upper limit, where you also have a bunch of sellers who are trying to sell at a lot of different high asks, and they're coming down and they're meeting in the middle at 180. There's still a lot of people who are trying to buy at 100 and 150 and 160 and 170. There's still a lot of people who are trying to sell at 200, 250, 300. But if you want a transaction to take place, you've got to get closer to the market. And every time a buyer and a seller agree on a price at the middle, that's when a transaction takes place. This is not just true of stocks, it's true of everything. That's how pricing works. When you go to the store and you buy something, the store has said, hey, we're going to sell something for this much, and you are coming in and you're meeting the market and you're buying it at that much. Given the store or the market, you might be able to come in. There might be some negotiations. You might ask for a discount and they might come down and meet you at a lower price. But this is how all pricing takes place in free markets, of course. Now, the reason why we need to understand pricing before we move on to derivatives is simply because when you have additional buyers, they're going to be competing with each other because they want to buy, and all else being equal, that will drive the price up. Because right now with Apple at 180, if you've got a bunch of people coming in to buy additional to what is already there in the market, maybe you have somebody who's willing to buy at 181. Maybe you have somebody who's willing to buy at 182. And if they've bought up all the shares at 180 and they've bought up all the shares at 181, then the only people willing to sell are now at 182 and 183. And if you have more buyers continue to come in to soak up that supply, that will drive the market up. Vice versa is true as well. All things being equal, more sellers competing for being able to sell will soak up all the buying pressure and drive that price further down. Now we can move on to derivatives, because many people understand this dynamic of buyers and sellers, of bid and ask, the spread, and look at that and say the very nature of derivatives existing means there's price manipulation happening, because now you have a secondary market that's basically betting on the price movement of that underlying asset, whether it's a stock, whether it's gold, whether it's silver, whether it's Bitcoin, whatever it is. And instead of that money actually going to the buying and selling pressure and showing up in the price, all that money is now betting on the price movement instead. And so you've got this secondary market that's taking buying and selling pressure away from the underlying, and you have at least somewhat of price manipulation taking place as a result. But that view doesn't hold up of scrutiny when you understand how derivatives markets are tied to the underlying, and I'll show you how they're tied together right here. Say you think the price of Apple is going to continue to go up, so you buy a call on Apple. If you're not familiar with options, a call option gives the buyer the right to buy that stock at a specific price during a specific time, and the seller of that call option the obligation to sell that stock at that specific price during that specific time frame. An example of this is you buy a call on Apple at $200 strike price for a month away from now. Let's say this call option costs you $5. You're basically saying, I will give you $5 for the right to buy Apple stock from you at $200 anytime between now and the next month. And the person who sells that call option to you is guaranteeing that right to you. They're giving themselves an obligation. They take your $5 in exchange. They say, okay, I'll take your $5, and at any time in the next month, you can buy Apple stock from me at $200. Right now, you think, because you bought that call option, you think it's a great deal because you think Apple's going to go up to $220. You're going to be able to buy Apple at $200. It's going to be worth $220, and you had to pay $5, so your all-in cost is $205, but you've got an instant profit because Apple's worth $220 right now, instant $15 profit per share. The person who's selling you that call option thinks it's a great deal because they don't think Apple's going to go up that much. They think Apple might go up to $185 or $190 or $195, and so they're collecting that $5 from you, and they think they're never going to have to deliver on that promise. They're going to collect that $5 from you, and at the end of the month, it's not going to be higher. They're not going to have to sell you that Apple stock, and they're just going to walk away with your $5. If none of that made any sense to you, it's time for you to take my options course. I've got a beginner's course and an advanced course. They're both linked in the description below. What you'll notice there is a buyer of the call option and a seller of the call option. What I left out though is that there's somebody else participating in that, and that person is called a market maker. There are companies out there that are just market makers, and their job is exactly what it sounds like, to make a market in any given security. And so when you buy this call option at $5, you're not actually buying it from somebody who's selling it also for $5. There's that middleman in between called the market maker. You're buying it at $5 from the market maker who got it from the other person at $4.90. They're making a little bit of a spread between the buyers and the sellers. They're the middlemen, and they're getting compensated for their job, which is making sure that there's liquidity in the market, making sure that if somebody wants to buy or sell, there's somebody to buy and sell to. And normally what they do is they do that. They try and match up buyers and sellers because they're in the business of making a market. They're not in the business of trading, of having a book, of speculating on whether markets are going to move up and down. They're just trying to be there to provide liquidity, get compensated a little bit on every transaction, do that a lot, and match up buyers and sellers with each other. And that way, if the stock does go up, then the buyer of the call option, you get compensated by profiting on the call at the expense of the person who sold it to you, who was wrong. And if the opposite happens, then the person who sold is the one who profits at the expense of you. The market maker tries to stay out of that. So here you might be asking a question. If that's the case, what happens if you want to buy a call option and there is nobody out there who's willing to sell that to you? Nobody wants to sell a call option because nobody, let's say, wants to take on the risk of having to sell their Apple shares at $200. What then? Well, you've still got somebody who's there, who's making a market, whose job it is to provide liquidity, the market maker. So me as the market maker, I'm going to have to sell you that call option that you want to buy. Maybe I don't sell it to you at $5. Maybe I sell it to you at $6 or $7 or $8 just because there's a lack of liquidity, so I can charge whatever I want. But essentially, the market maker will still make the market. They'll still provide liquidity, even if there's not somebody that they can match your trade up with on the other side. But remember what I said earlier, market makers are not in the business of speculating. They're there just to provide liquidity, so they have to hedge somehow. If they can't get rid of that trade and pass it off to somebody else, they have to hedge. And this is something called delta hedging. If I've just sold you a call, and that means you have the right to buy Apple stock from me at a given price, I'm going to go turn around. I'm going to buy some Apple stock right now so that if the Apple stock goes up and you require that I deliver that Apple stock to you at $200, I have some shares that I can give to you. I'm not leaving any risk on the table as a market maker for Apple to go up to $250 and then I have to go to the market at $250 and buy it and then sell it to you at $200, which would be a devastating loss for me. I'm not in that business. I'm in the business of hedging and making a market. So I'm going to go right right now and get enough shares to compensate me just enough if the shares go up and I have to deliver good on that promise to sell you Apple shares. So here we're going to pause, and I need you to notice two things. In the first example, when there's money buying and selling just the shares, you have buyers coming in, driving up the price, sellers coming in, driving down the price. In our second example, you have two market participants, a buyer of a call option and a seller of a call option. The options are derivatives. In this case, they are canceling each other out. Even if all that money, $100 each, let's say, went to go buy and sell the actual underlying, the stock, you still wouldn't have any impact on the price because they match up with each other. Their pressure would cancel each other out. You would be adding the exact same amount of buying and selling pressure to the market. No price movement. In the third example, you have a buyer of a call option and nobody on the other side willing to take that trade. So the market maker has to provide that liquidity. But what do they do to hedge? They turn around and they buy the actual shares. They buy the underlying to hedge themselves. So in the absence of a counterparty that the market maker can assign that trade to, where that money would cancel each other out, you still have the call buyer contributing to the price rise of the stock because the market maker has to turn around and hedge by buying stock. So if you have a ton of people buying calls over and over and over again, there's just a ton of money buying calls. All of that money is turning around through market makers having to hedge, buying up the shares. This results in something called a gamma squeeze, which many people participated in I believe it was August or September of 2020. There was a massive spike in the stock market because of so much money going in buying the derivatives that made that money have to flow through and buy the underlying. And so contrary to derivatives price action taking place and people thinking it might take away from contributing to the underlying, in contrast to that, many times what actually happens if you have major imbalances is it contributes more so because those derivatives have a lot of leverage. But what happened immediately following this gamma squeeze? You saw the market come back down ferociously. Because it's so much leverage, these positions at some point must be closed out and the market reverts to its mean and comes back to normal. And if you don't have the gamma squeeze take place and the market makers are basically just able to line up, match up buyers and sellers of the derivatives with each other, there wouldn't have been any impact on the market anyway because, again, there's a balance of buyers and sellers keeping that price at equilibrium, not driving it one way or the other. But there's a catch, and I think you may have noticed it because people who watch this channel, you guys are fairly bright and you understand that indeed manipulation does happen, especially in some securities using derivatives. And you might have noticed it was when I said that at some point these positions must close out. That probably sparked a question in your head that said, but what if those positions don't ever have to close out? So why do they have to close out? Well, because the people who are at a loss, they start to lose more and more money. They risk insolvency. They have to close out. The people that are at a gain start to take their profits, and eventually that reverts back to the mean. But what happens when you have somebody who does not have to close out their position if they start to lose? What if you have somebody who can continue adding to a losing position indefinitely? And that's where we enter with banks, because banks, through access to bailouts and access to the money printer and being able to get exemptions on different rules, how much leverage they can have, many times are able to load up and double down on their short positions using leverage, using derivatives. This happens a lot in silver, happens a lot in gold, happens probably increasingly so in Bitcoin lately. You have shorts able to enter the market, and if the market starts to move against them, they don't really care. They just add more shorts. Now, if you or I tried to do this, what would happen is we'd eventually get a margin call. If we started losing and stacking up our losses over and over and over again and more and more and more, then at some point our broker would call us up and say, hey, look, you're losing money. You've exhausted all of your money. If your losses get any bigger, that will then start losing me money. So I'm going to close you out of your position so that you don't cause any risk to me. Closing you out, margin call. You are not allowed to let this loss run any farther. That doesn't happen to banks. Many times they're able to, eventually it does, but in the short-term course of things, many times they're able to double up, triple up on their shorts because they've got an implicit bailout. They've got this money printer behind them that allows them to continue adding on to their short positions. So in the case where you don't have the ability for somebody to be margin called, where you don't have the incentives for somebody to close out of their losing positions instead of adding more, then you do, again, short-term temporarily have manipulation or suppression, depending on which side the manipulation is on the actual underlying. Because remember, all those shorts, they do pass through to the underlying price action. And so if you've got somebody who's loading up on the shorts more and more and more and more, that will continue to suppress the price. Now, eventually, this does fail. If this didn't fail, you'd still see gold down at its price of $200, $300 every time it's hit one of these plateaus where shorts get loaded up on it. You wouldn't ever have that break. You would have them do it to infinity. It's not possible because eventually these things do make their way back to the physical markets, to the underlying, and the fundamental dynamics take over and break the market. That's why you see things like GameStop skyrocketing, because all the hedge funds had to close out. That's why you see AMC skyrocketing. And so eventually these things do break and the price will revert to its mean. But when you have a player who's able to do far more in terms of ignoring losses than free market participants are usually able to, that suppression or manipulation can last a lot longer. I hope that helps, that explanation of pricing, how pricing works, and then how derivatives make their way through to influencing the price in absence of a counterparty through hedging. And if you have any questions, because I know a little bit of a confusing topic, let me know. I'll do my best to answer all the questions in the comments below. Thank you so much for watching. Have a great day.